After what you saw from this report yesterday, did it change your rating or your price target for the company? What was your overall take?
So we lowered our price target this morning, and it mostly relates to the outlook for earnings. It's coming in their midpoint of earnings. I think the consensus and our expectation was that they would have upside and beat expectations based on the cost-cutting program. And what happened is, as you mentioned, they lowered their revenue outlook, and I think that's really key. A lot less volumes are flowing through the system.
All right, so I'm looking at, you just put out a new note this morning, actually. Previous price target was 334. You lowered it down to 313. You still seem to be fairly bullish on the stock. That's a 20% upside. Big rally in the stock this year. What's the catalyst to keep that rally going in your mind?
Well, I think that's key. Right? The rally is due to the concept of this drive savings, right? They've built in $4 billion of savings, almost $2 billion this year alone. That's the key, right? Without that, you'd see what's going on at UPS is this huge impact of less volume and the negative leverage you get from that. So they had $1 billion of profits last year. They would have lost about $1.8 billion based on these impacts post-COVID and less volumes. And so with the drive program, you get $1.8 billion. So you're getting about $1 billion of profits this year, flat with last year, but you would have had a lot more leverage with these cost cuttings going in.
All right, as we said, Express was under pressure, missed margin estimates by a lot. But the lower in the revenue guidance, that was interesting. A lot of people thought they were actually going to beat on EPS and raise. Were you a bit surprised by the lowered revenue guidance, especially when a lot of people think they gained business from UPS during the Teamster negotiation and from the closure of Yellow?
Well, the Yellow is definitely true on the freight side. We can see that on the Express side and ground, really, ground is where they kept the volumes from UPS, and you did see that flow through. Margins were great at ground. But really, the key is at Express, as you're talking about, and the negative leverage from having lower volumes, but yet still flying a network, flying your planes and keeping a network running, that's the negative network leverage that's flowing through. Right. And that's really been the big overhang for FedEx. And that's the disappointment, really, in coming into their midpoint of their range versus beating expectations that the street was expecting. All
right, so again, FedEx shares under pressure. We want to broaden this out just a bit, Ken. Stick with us here. We're going to look at the transport stock playbook for 2024. Deutsche Bank is forecasting 11% earnings growth in 2024 for a number of transport companies, including UPS, Union Pacific, C.H. Robinson, and most of the other major carriers. This following a 20% earnings contraction in 2023, a year marked by a freight recession and the historic bankruptcy of Yellow. Companies like FedEx, XPO, and Saia that operate in that same less-than-truckload space as Yellow, seeing some big stock moves in part due to customer gains. We were just talking about it. FedEx also gained customers during the UPS Teamster negotiations. A big question for 2024, will the supply chain finally normalize? And what will that mean for rates, especially in trucking? Trucking offers the closest thing to a real-time look at demand. Those rates have rebounded across the board, with industrial and food and beverage trucking actually higher year over year. Citi out with a new note last week, naming rails as their top pick for transports in 2024. This year, overall traffic is down 3%. Container shipping on rails is actually down 6%. But Citi's forecasting an upside of mid-single-digit volume growth and double-digit EPS growth. Ken, we just kind of broke down some of the key parts of the supply chain. We were talking shipping earlier. What's your take on some of the views of some of your colleagues in the transport space?
Well, there's no doubt that when we look at the top pick, Union Pacific and what Jim Vena, the new CEO, is doing there in terms of revamping and cost cutting. So you look at idiosyncratic opportunities. Last time you and I chatted, we talked about this elongated freight recession. And our truck shipper survey that we do every 2 weeks tells us that we're still at a very muted demand environment, even with the activity we've seen lately. And so without breaking out yet, we're still looking for that cost cutting. So Union Pacific is kind of the focus that we've been highlighting with Jim Vena. And I think you just mentioned the rails. So really active on the rail side. When you think about then starting to get growth, if we start to see that inflection, we've highlighted truckers like Knight and J.B. Hunt on the intermodal side, right? Seeing that they're usually the first movers of that. And then as we move in, we've highlighted within the LTL sector, as you mentioned, companies like XPO, Saia, Old Dominion, where you still get this lag benefit from that Yellow bankruptcy. That's going to flow through. So really see, again, the rails, very good activity. You're starting to see volumes.
So you agree, that's going to see the biggest upside in 2024, the rails?
Well, again, that one is talking about Union Pacific specifically because of what Jim is doing on the cost cutting. So you don't need the growth. If you get the growth, then you get all the other leverage that you're talking about to get the volume. So we need the volume to flow through. Up front, we focus on the ones with the cost cutting.
So you mentioned intermodal, that's container shipping. That's generally how the majority of consumer goods get into the U.S. when they either come from Asia or even actually now from Mexico, as we see nearshoring ramping up. When we look at that, isn't that heavily levered to consumer demand and consumer spending? So what's your outlook on I guess it's a proxy for consumer spending. What's your outlook on that container shipping?
Well, like you said, there's been a lot of congestion that we had to deal with back in 21 and 22. That has freed up, but the rail service was so bad, so they lost volumes naturally to the truckers. You're seeing that service greatly improve, and so you're seeing an improvement there, winning back volume off the trucks. So that's part of domestic intermodal. International intermodal is still slow. We're starting to see that flow back from Asia. As you mentioned this morning, given what's going on in shipping lanes, you're going to see longer shipping routes. That might move some stuff back to the West Coast from the East Coast that happened into the strike this year or contract renegotiations. And so you might see the West Coast picking up some of that intermodal, and that's good for long-haul intermodal.
So we just showed the rebound in trucking rates. Trucking is generally about 75% of at least the U.S. supply chain. So just yes or no. Are we out of the freight recession or still in it?
We're in an elongated one. We're hopefully coming out of it into 24, but still in this muted period. And that's what you see with FedEx results, and that's why revenues and volumes were down.